Boom. Hey guys, I think we're in good company. I'm with people I know. I am Zap, community lead at the Entrepreneur Center. Thanks for joining us in this virtual world. What is exciting is I'm actually back in the EC building. So if you know the building, I'm in the treehouse room. So least picturesque, but looking over a couple of members who are sitting here. You're welcome to come in, although you do have to wear a mask unless you're in a room, which I'm in a room, so I'm following the rules. A couple of things, I guess, reminders is I just put on the calendar, you'll see on June 3rd, we have a launch with Dell for Entrepreneurs. So they're like partnering us. They're giving entrepreneurs discounts to their products, but also they're talking about raising capital in a crisis. So I'm super stoked for that event. Other than that, we're super excited to have Carolyn here from Strategic Financial Partners to talk about the big topic right now, money. Anyways, I will hand it off to her, but thank you for joining us.
Thank you, Zap. It's great to be here. I also wanted to thank Haley and Jane. I know they're not on the call right now, but thank you for inviting Tyler and I onto this Zoom call webinar. A little bit about my background for those of you who are not on my last speech or last talk last week. I'm originally from New York City, so I tend to talk fast. I apologize. I'll try to slow it down. Spent 20 years on the corporate side for JP Morgan and Goldman Sachs, helping companies go public, so raising money, very familiar with that. I then did a couple small stints for some small companies. The last one before coming on the private side was helping a friend of mine startup company in Boston. I was the acting CFO for her company. So I've sort of played many roles in my financial background. About 3.5 years ago, my husband and I moved here to Nashville. He's a retired police officer, and music's always been his passion. So he started the first summer he retired working on his webpage, and all started getting some hits for auditions here in Nashville. I thought he was honestly going through a midlife crisis because he said one day, I think we should move to Nashville. Long story, he convinced me. Our 5 kids are all grown, launched on the East Coast, pursuing their careers, one starting her own business as well. And so we moved here, and I decided to take my financial knowledge from the corporate side to the private side, helping individuals and small business owners like all of you plan for the future. So today I'm going to talk about understanding the places to withdraw money in a volatile market. That's very pertinent today because every day I feel like I'll check the Bloomberg 1 minute, come back from the bathroom, and it's gone a completely different direction. So we know the route to financial well-being will be different for everyone, but regardless of what path you take and what business you have started, it's very important that you have a strong grasp of fundamentals. While everyone's financial situation is different, in a volatile market environment like we have right now, we find that staying the course in terms of your investments and not making change can be beneficial. So today, as I said, I'm going to talk about other platforms to pull your cash out of that will not impact the returns of your marketable securities. So some of you might be saying, what is that platform? And that platform is essentially the cash value from life insurance. Oh, hold on. Tyler's not sharing my presentation yet. Hold on. All right. Can you all see it now?
Yes.
Okay, perfect. All right. So go to the second slide. Okay, perfect. So before we dive down into what it means to basically have the financial well-being, I want to put things in context. As defined by the Consumer Financial Protection Bureau, what it means. It's 1, having control over your day-to-day, month-to-month finances. 2, having the capacity to absorb a financial shock. 3, being on track to meet financial goals. And 4, having the financial freedom to make choices that allow one to enjoy life. So as we go through today's discussion, we'll mainly be addressing the second bullet point, which is having the capacity to absorb financial shock. Since life insurance is primarily designed to provide for your loved ones in case of an unexpected event. And that's why this is so critical in a volatile market like we have today. We're also going to touch on how life insurance can help you stay on track to meet financial goals, as well as have the financial freedom to make choices that allow you to enjoy life. All right, having said that, let's begin. So here are some things we'll touch upon today. Some of this might be familiar territory to you, but there might be also some opportunity to learn some new things or just have another perspective on some of these topics. So we'll first start talking about what life insurance is and who might need it. Next, we'll talk about types of different life insurances available to you, specifically the difference between term and whole life insurance. And finally, we'll talk about the things that you may want to consider as you discuss with your business partners, your family members, whether or not life insurance is right for you right now. So life insurance is a financial product that, in exchange for timely premium payments, pays a death benefit when the person who is insured dies. The death benefit is paid to the policy's beneficiaries and is received by them, generally speaking, income tax-free. But if you have people who depend on you financially, a life insurance policy is much more than a technical definition that you see here. Life insurance is essentially financial security for the people you love, also your business owners as well. I just mentioned that life insurance can be the financial security for the people that you love or work with. What do I mean by that? Honestly, I can't tell you what that means. That's because financial security for your business partners, for your family members, can only be defined by you. Perhaps it means replacing your income for a certain number of years. Perhaps it means giving your family a fresh start financially, one without debt. Because I know when you start a company, we often have to use leverage to fund some of the investments. So although a lot of you in the starting phases probably have a lot of debt, you think about what happens if you don't come home tomorrow. Would your family members want to be basically the bearers of that debt? Or maybe financial stability also means helping the loved ones take advantage of something that you don't have in the future. For example, like attending college without the burden of student loans. So however you define financial security for your family and your loved ones, one way of helping them is to reach their goals with life insurance. And of course, now I've got to add the disclaimer, because as a beneficiary to the life insurance, the death benefit, what they do with that money is totally up to them. So you can tell them what your intentions are, but once you pass away and the money's theirs, only they can decide how to prevent it and how to spend it. You know, they might go off and buy that Maserati, who knows? So I just have to say that out loud. So who should consider life insurance? Obviously, anyone who has people who depend on them financially. And again, that can be a family member, it can be a business partner as well. And many people think of life insurance as necessity only when they have children. But the reality is that you have lots of people who depend on you. Other than the obvious, like a spouse or kids, other people like your parents who might be getting older and might need your financial support or even physical support as well. But think about other people in your life who depend on you. It may be more people than you think, especially with small businesses. You know, if you and your business partner put money in 50-50, you might want to make them part of a beneficiary as well, because you want that business to keep going. So lots of things to think about from a small business perspective. So even if you don't have any financial dependence now, consider what you also might have in the future. If you're young and you think you're going to have children, something to think about right now, because for many young people starting out and looking to build a financial foundation for the future, life insurance might be a very attractive option. And when you're young and healthy, this is when the premiums are most likely to be the least expensive, and it can be the best time that you can lock into them for the rest of the term or the life, which I'll get into in a second. So there are numerous policies to choose from. There are basically two main types of life insurance, which I want to talk about. One's term insurance and one is what's called permanent insurance. And both of these types of policies serve the main purpose of providing protection in the event of death of the insured. However, the way they function is very different. So let's start with term insurance. Term life insurance provides death benefit protection to a specified number of years, which is called the term, and generally offers the lowest premiums. The most popular policy types are between 10 and 20 years. Some companies even offer 30 years, and you can do a variation. You could do a 15-year, So that is very flexible, but the 10 and the 20 year are the most popular. And the reason why those are popular, because it kind of matches your debt obligations. Often you've got a 10 or 20 year term on your debt or your revolving credit, or you have student loans that you want to make sure are covered or don't going to be a burden to your family members, stuff like that. So a lot of people match the term with some of their debt obligations. And these policy offers premiums that are guaranteed not to change for the guaranteed level premium period. So for example, if you took out a 10-year policy, those premiums would never change for the 10 years, same with the 20 years or 30 years. And at the end of the term, you may continue coverage, but the premiums will increase annually. The longer the guaranteed level premium is, the higher the premiums will be. And this is because the older you get, the cost of insurance increases. The insurance companies calculate a level premium that will cover all the costs over that term period. There's also something called annual renewable term, otherwise known as ART, where the premiums cover 1 year at a time. And these policies generally start out a lot lower, but every single year that premium goes up over time. In general, annual renewable terms are only make sense if you really only need a short-term coverage, 3 to 7 years. 7 years is kind of the breaking point where it's better to get a term policy than an annual renewable term policy, because after 7 years, you're much better off dollar for dollar doing the term policy. So one way of looking at term insurance is thinking about renting a place to live. You have the policy for a specified amount of time, but once the policy expires, you don't own anything. It's kind of like renting a place to live. So the other type of life insurance is called permanent insurance. And permanent life insurance is as it sounds, it is permanent. The insurance covers your entire life as long as you pay your premiums and don't allow the policy to lapse. And some policies offer premiums that are guaranteed not to increase over the entire lifetime. And finally, permanent insurance policies can also build cash value. And this is the platform I was talking about where you can pull the cash out from your life insurance policies in a down market. That way you don't have to pull out from the stock market. We'll talk about more of that in a few minutes. Permanent policies also have a lot more flexibility in terms of the way you can structure them as well. If you think you want to pay for it for only 10 years, then not have to contribute anything more, we could do what's called a 10 pay. So you basically compress all the payments up front, which hence enables you to build more cash value quickly. So in terms of, we talked about term insurance being like renting an apartment. Permanent insurance is almost like owning an apartment because of the cash value, the equity that you are building up year after year. So we build our financial lives over time by acquiring various types of assets. And these include our homes, our cars, and financial assets such as bank accounts, investments, and retirement accounts. In addition to the death benefit, the cash value can also be considered a financial asset that may be available to you. So say, for example, you had $10,000 of cash value built up in your permanent life insurance, and you needed to take out $10,000 to grow your company, to invest in the newest technology, whatever it is. Where is the best place to pull that cash from? When the stock market is down and the value of your marketable securities decrease, it's tempting to ask your financial advisor or me, what should I do? Should I pull out of the market right now? And that is understandably wrong. Instead, you should be asking, what should I not do? And the simple answer is don't panic. Panic selling is often people's first reaction when stocks are going down. Because you need the money right now, you need to grow your business, and you're like, well, I have it there. Yeah, it's going down. Maybe I should pull it out and try to salvage any more losses. But I can guarantee you look statistically, and this will lead to a drastic drop in the value of your hard-earned funds. As a long-term investor, trying to time the market's tops and bottoms is foolish. The evidence is overwhelming that most investors diminish their long-term returns by trying to do so. Market timing, while tempting, involves two nearly impossible decisions. One, when to sell, and 2, when to get back in. So instead, you need to have another platform or investment opportunity to pull money from in these volatile markets should you need the cash during this time. And that is what the cash value of whole life permanent insurance is used for. The cash value too in the life insurance products is not tied to the market. So it is not volatile, it is a guaranteed. In times of these ups and downs, one of the things I've been hearing a lot from my clients is they want guaranteed value. They want guaranteed investments. And that's what permanent insurance does, because the cash that you earn is guaranteed at a minimum to grow over time, because every year you get dividends from the insurance companies that go into your cash account and that are not tied to the stock market. So if you own permanent life insurance, it's designed, as I said, to accumulate cash value. And so you ask, what can that cash value be used for? It can be used for retirement planning, college funding, or any source of cash or credit that you might need. For example, putting it into your business. There is no restriction on what you can use your policy's cash value for. So it can be used to meet any of your financial needs. Plus, you can pull it out tax-free. Let me say that again, tax-free. The money you earn on that, you pull it out, you don't have to declare it, you don't have to pay any taxes on it whatsoever. So let's discuss how permanent life insurance can fit into your overall financial plan. People often assume that their need for life insurance ends when they stop working. However, a permanent life insurance policy can provide additional financial security for you during retirement. First, the death benefit of your permanent life insurance policy can be used to help fund the surviving spouse or partner's retirement and lifestyle. Second, the cash value can be an alternate source of income that can give you the flexibility to manage your retirement income more effectively at different points in your retirement years. With access to the policy's cash value during your retirement, you can use it to supplement your existing retirement stream periodically to take advantage of any opportunities that might arise. For example, putting it into the company, making more distributions. You could also withdraw less income from your retirement accounts, especially during periods of negative volatility, when it's more advantageous to limit your withdrawals. And also you can have more flexibility because you can use other retirement assets more effectively. Again, going back to the notion is you never want to pull out of your marketable securities in a down market. You need other platforms of investments to pull from in the down market so that you don't deplete your assets. The cash value potential of your life insurance policy can also be used for college planning. For those of you with young children, that might be on your mind. The life insurance policy's death benefit could be used to your loved ones to pay for future college funds if the needs arise. Secondly, it also, your ability to access the cash value of the life insurance during your lifetime may also limit the amount of student loans you might be required for college. And third, the cash value of your policy can be used to supplement your existing college funding strategy. So like some investments where you can't double dip, for example, you can have a 529 plan, which is a college funding plan set up for your children, have a life insurance policy, pull out cash from your life insurance policy and from the 529 plan, and use those resources to fund college or secondary education. So, and also, but what about the other expenses that are not considered what I call from qualified plans, the 529 college plans? So 529 college plans are basic, they have limitations. Yes, you can use it for they call secondary, so high school and college, but these have to be on qualified expenses, which are tuition, room and board, and books. If you ever have gone to college, you know there are a lot more expenses than just those. If you live off campus, there are qualifications that only a certain amount of that rent, depending upon what the school charges for board, can be paid for from a 529 qualified plan. My point is 529 college plans are great, but they don't cover all of the college expenses. So that's why a lot of people use the cash value from their life insurance products to help cover those other expenses that are not covered from the 529 plan. So planning for retirement or planning to pay for college or planning to invest in your business, there are many ways that you can use this product, the cash value, to use it. Outside of those plans, the potential cash flow that your permanent life insurance policy accumulates can be an additional financial resource during the time of need. For example, the cash value can be taken out as a source of emergency funds. It can cover the cost of healthcare services. It can fund your business. It can take care of your family needs that you might have, or even, say your loved one has some medical expenses as well. You can use that for that as well. So let's talk about how much life insurance you might need and whether it's term or permanent insurance. The consideration is the same. What I like to recommend is you start with your goals. What do you want your death benefit to accomplish? Is it to replace your income if you were not here? If so, take your income and multiply it by the number of years you think it's appropriate. For example, if you've got young kids and you want to make sure your spouse has enough of your income to cover, so your 2-year-old until he's in college, you probably want to do at least 16 times. So 16 years until the youngest child gets to college is the number of years you want your spouse to have that income replaced. Sometimes it's also to eliminate debt, and many people purchase a policy in the amount of equal to their mortgage or other outstanding liabilities. So how much you'll need depends on a number of factors. Including in your goals, you need to consider your income and your debt. You may also need to factor in any employer benefits you had beforehand that you wouldn't have, so especially for not you business owners, but maybe your spouse, that they wouldn't have if without you, or if they didn't go to work tomorrow. And I also like to bring up what I call the unpaid services that you provide, like childcare, elder care, cleaning, transportation, home repair, maintenance. When you consider all those unpaid services you provide in your household, it may become very expensive, if not necessary, for your family to hire somebody to perform all those. If you are the one that always fixes the sink and the leaky sink and drives the kids to school and does the cleaning around the house, if you were not to come to work tomorrow, would the surviving business owner have to hire somebody else? Probably. So how much life insurance you need is really a very complicated decision. I'm happy to sit down with all of you and go through some numbers in detail, but that's sort of the start of how much is needed. So if you already have coverage, good for you, but you want to review it regularly and make sure it still meets your goals, and make sure you understand what you have too. Do you have term that does not earn cash value, or do you have permanent that does? You also want to consider things that have recently occurred in your life. Do you have a new kid, a new house? Are you married, divorced? Any of these life-changing events warrant reviewing what you currently have. And what future life events are expected or are already planned for? Has your health improved? If so, lower premiums might be available to you. Are your beneficiaries up to date? Is there somewhere when you no longer want as a beneficiary? And I laugh because I get that quite a bit, not quite a bit, but at least once a year, I'll have somebody call me up and they're like, their third oldest child, I guess, has been the black sheep this year, and they want that child off as a beneficiary. And I'm like, okay, I don't need to know the story. I'll make sure the changes are made. So that's, you don't have to notify your beneficiaries when you make those changes, but that does happen. And then just, I always recommend people to make sure your financial professional is still active. If you have somebody that you rely on, that's great, but there's a lot of turnover in my industry. So you need to know what that person is, if the person's still there, when was the last time you talked to them? If they've left the firm, who is still the servicing agent, I say, on your policy? If it's been a number of years, this might be something that you should look into. And then lastly, if you have existing insurance, who is that carrier? Meaning the company that has issued the insurance to you. Is it a financially strong company? And that's very important because reliable life insurance companies are generally rated on financial strength by several rating agencies. That includes Moody's, Standard & Poor's, Fitch. And these financial strength ratings are key indicators of the company's ability to meet its financial obligations. Basically making sure that if you pass, they have the money in the bank to pay your beneficiaries. So you want to make sure, if you do have existing policies, that these are backed by solid ratings. So we covered a lot of information today. I want to thank you for taking the time and summarize. I just want to summarize a couple of key points we discussed today. First is providing financial protection for the loved ones and your business partners is a critical decision. Two, stay the course as trying to time the market is nearly impossible. Think about what type of policy best suits your need, term or permanent. Some permanent life insurance policies have the potential to accumulate cash value that can be used for your needs, including college funding, growing your business. Just make sure that insurance meets your current needs. That's the whole thing. What is your, going back to your projections I talked about last week, what does your business plan look for? How much money are you looking to put in your business? And adjust and create a plan such that life insurance policy can grow that cash to kind of match those financial needs. So that's all I had today. Right now I'm going to open up to any questions that anybody have.
Hello.
Yes, hi.
Hi, I'm Ryan Pierce. Thank you so much for the presentation. I'm 21 years old. I didn't think there'd be too much for me to learn here, but this was actually really, really cool. I was really like in depth of what was going on.
Oh, good.
That said, I have a couple of quick questions.
Of course.
I'm still trying to wrap my head around, this space, so I'm still a bit new, but one thing that I'd like to ask is, given the amount of benefits that come with permanent life insurance, what would be the benefit to anyone doing term? I mean, why would anyone want to go that route when it seems like everything's so good?
That's a great question. So let me just back up for a second. Because term does not earn cash value, the monthly contributions is quite a bit less. Permanent, because you are getting that dividend, tends to be more expensive. So sometimes people don't have the budget to get into permanent right away, but they want to take advantage of the fact that they're young, they're healthy, they're insurable right now. Another factor on term that I didn't mention, because there's a lot more I could go into. If you get term within the first 10 years, you actually have the option to convert it to permanent at any time without any further underwriting. Now, you don't start accumulating cash until you convert it, but you don't have to go through underwriting again. So I've seen a lot of clients that either don't have, they're starting out, they have a limited budget of, okay, they say I've got $30 extra a month I can spend. So maybe we start with a term policy knowing maybe in 3 years, they're going to convert it to permanent. Some other people say, listen, I want permanent. I can't afford $1 million, but I can do 500,000. But I want basically $1 million of coverage because they've got a $500,000 mortgage, they've got $500 business loans. Between the debt and the income they want to cover, they need $1 million of coverage. What we often do is then what I call layer it. So I do like a $500,000 permanent that at least part of it starts building up cash, and then a $500,000 maybe 20-year term that at least covers their debt and their liability. God forbid something happens to them, they're not going to be a financial burden to their family. Does that make sense?
No, thank you. It makes a lot more sense when you put it inside of that perspective. So thank you. 2 more questions, if you don't mind. I'm sorry.
No, right ahead. Shoot.
All right, cool. So second question, is there a cap to how much you can pull regarding your cash value with permanent life insurance?
You can pull up to 90% of whatever cash value you have built up. And when you pull it out, say the example, you had 10,000 of available cash value, you pull that out. If you pass the next day and you haven't paid that back, your death benefit gets reduced by whatever you pulled out from a cash value perspective. Mm-hmm. You don't have to pull it back out. It basically takes your cash value almost down to 0, and then you start drawing up again. So say you pull out 10,000, you don't pay it back, 10 years down the road, you've got another 10,000, you can pull that other $10,000 out again. All along, the death benefit is increasing over time exponentially. So in 20 years, say you've pulled out $20,000 and your $100,000 death benefit has grown to $140,000. Mm-hmm. You technically still have like 40,000 or 20,000, the 10,000 for the first time, the 10,000 from the second time that you pulled out, and that would be reduced from your death benefit. Mm-hmm. But there is you can pull out as much and you don't have to pay it back, and it's all tax-free, which is awesome.
Great, cool. And the last question. So I'm in a space right now. I'm going to be graduating college pretty soon. And I am trying to think about laying the foundation for, my future and things like that. So regarding like financial assets, would you recommend going ahead and opening up like a life insurance policy first before maybe a Roth IRA, or starting to play around with stocks or something like that? Like what order do you think you should do things in?
That's a great question. So the way I work, my opinion, and you're going to get lots of opinions out there, I always start with what's called the base. It's sort of like building a house. You want to protect your assets first. And, we all have insurance on our cars, insurance on some even on our phone or laptops. What is the most important piece of property or asset that you have? It's yourself. It's your ability to earn income, to create companies, to, be the father, be the brother. It's you. So I think getting at least a small, even if it's term to start with, is a great building block for the foundation of your financial plan. The next phase of what I call the building block of the financial plan is what I call the sexy part. It's the accumulation stage. That's where you open up Roths. That's where you start with mutual funds. You start growing the money that you've made and make that money work for you, that you work so hard for. The last part, which is never the plan, is the exit strategy, whether it's exiting from the business or exiting from your work, the retirement stage of life. And it's never too early to start thinking about that, because there are some things some people know. I want to travel, or I want to give everything I've earned to my church. And you can change that, but if you have an idea of where you think you want to start, there's certain ways in the investment part that we can do that to make that last stage, the retirement stage, more tax efficient. So bottom line, yes, I think doing a small policy, permanent or term, depending upon the budget, is a number one way to start. We can certainly open up a Roth, and you can fund it with any extra income. We've done that. And then, opening up a Roth doesn't cost you anything in terms of the paperwork. And then we can figure out, you have 3 months to fund it once you open it up. And then you can start putting money in on a one-time basis, on a monthly. But definitely make sure you get a life insurance policy to start with, because also think about this. We don't know what tomorrow is going to bring in terms of our insurability. Mm-hmm. If we get the COVID and, say it has long-term effects, you may not be insurable 6 months down the road if you're sick and your immune system now is totally compromised. We just don't know. Mm-hmm. But if you're healthy today, you're as healthy as you are today, and you're young, take advantage of it right now.
Thanks so much. No, I really appreciate that.
Of course, Ryan. Any other questions? No questions too small or silly.
All right, I don't think we have any more, unless Ryan, you want to come up to bat one more time.
I think everything's been answered though, but thanks so much.
Okay. Well, my number's up there. So if you have any questions, feel free to reach out to me. And I know Zap has recorded this. If you want to go back and, go over to other stuff, let me know. Yeah. Thank you so much for taking the time out of your busy day.
I will send
Talk to you soon.
Bye-bye.
Bye.